Well, all right. Well, good morning, everyone. We're going to be doing a review of the Boring Bulls transaction model for the year of 2020. So let's get started. A couple caveats that I will throw out is that the model evolves over time. And so as we make improvements in it, we don't come back and remake these videos. So you may go on the website in a week or a month or a year and see, wow, there was a much better result that happened back in 2020, and that's okay. That means we're getting better. Anyway, just kind of keep that in mind that the numbers could change over time as the model evolves. So what is the Boring Bull? For those who are new, Boring Bull is a website that educates and demonstrates the power of quantitative investing. Of course, that could also be known as algorithm investing, computer investing, quant investing. Basic idea is pretty straightforward. You bring together financial information or knowledge, or even things like macro indicators I'd throw in there as well. All that type of information about our economy, GDP, CPI, etc., all fall under that financial box there. We add to that technology. Now, it could be computers, it can be cloud computers, it can be simple models like machine learning, or advanced like machine learning, simple algorithms. Math is the third box. Again, that's where it could be a moving average. That's pretty simple and easy to understand, to something much more highly complex, like nearest neighbor or k-learning or decision trees. We can get really advanced in any of these areas, but as we pull them together, they create a model, and a model that allows us to remove emotion, remove thought. We just let the model dictate our actions in our trading. So that's kind of what this is. So hopefully we're going to review this year. Let's see how we did. So in summary, we had 6 transactions, and a little above average, 5 on the positive side, 1 on the negative. A really outstanding year, though. Wow, 123% is more than doubling your money in a year, which is absolutely just tremendous. Almost 3 times the average, really, when you think about it. Our max drawdown was around 18%. At particular high point versus some low point during the year. So really excited about that. Probably not quite the best year we ever had, but oh boy, made some good money this year. From a returns kind of perspective, there are kind of some points here to look at that are observing that price movement. Again, the S&P portfolio is in the purple. Our model is in the blue. One of the big things, as you know, about 2020 was, of course, the major drop due to the COVID scare. It looks like, looking at it, we escaped it. You know, we had an override kick in, or I believe, and that's what dropped number 1 down really quick. Then we missed the majority of the drop, and that's good. Many of the overrides probably kept us from trying to get back in. Now, on the other hand, you can argue, well, if you could have got back in, let me get the laser pointer out here. If you could have gotten back in here, you'd even done better, and that is absolutely true. However, the model is the model. It's not to have that emotional thing. The good news is there was a lot of great rides, a lot of great rises that we took advantage of, and that's how we were able to produce the kind of volume or the kind of returns that we had. So it could have been better. Absolutely could have been better. Hindsight is always 2020, but we were able to catch a lot of those high rides. Especially, I mean, this one here is obvious. So let's look at the transactions. We had our first transaction, we got about 12%, so a pretty good start to the year. Then we lost 13 when that override kicked in, and that's really down 13% when the S&P dropped, what, 30%, somewhere in that vicinity. So losing 13 wasn't that bad. Obviously, we more than made that up in the next 2 transactions, totaling, wow, what is that, almost 80% in just 2 transactions. And then we had 2 more what we call normal transactions that followed. One very low but still positive, and then one that was pretty decent. Certainly 14% is nothing to laugh at. When we look at the price movement overall, obviously the observations here are the great drop. It's a major correction. It also kind of makes me want to point out that the model is a mathematical model, as all of them are, right? What they don't do a really good job does, as any financial model would do, is to predict a black swan. These are events that happen that trigger massive disruptions in the stock market, and clearly COVID was that black swan event that it's very difficult for folks to predict. So people got burned for that. There's always going to be some kind of events like that, like a Fed rate hike or something along those lines, or some other news, but you can't predict 9/11, you can't predict wars, let's say. So just kind of keep that in mind. I was obviously looking at some of the problem areas. Certainly this is a major issue whenever the moving average breaks below the exponential moving average. That's never positive. Almost did it here. And then after that, it didn't do it again, and then we kind of saw that steady growth minus these more COVID anomalies for that year. We did see the price, however, drop below the exponential moving average a few times. Again, those are worrisome. They do make us very nervous when we see those. But on all, those are usually more temporary and usually are faster to adjust themselves. From a year perspective, we look at it, we did avoid this major drop, which is great, and that's probably why our results were so positive. Volume-wise, obviously you're going to see those large volumes here, and they kind of continued throughout the year. Got a little more normal in the September, October time period. Had a few spikes back in here. So it was a pretty large volume year, especially when we look at March and April. From the indicator perspective, we did have quite a bit of oscillation. There were many times here in which the break point or the entry point and the exit points were altered by the model. We don't really like to see that, and I'll show you the VIX here in a minute. We just don't like to see that. There weren't as many sell opportunities. As you can kind of see, buying seemed to be more pervasive this year. That's one of the issues, of course, with any model is you really like to see that oscillation have an equal number of sells and buys, but here clearly the buy was more prevalent. From the pure indicators, remember that our indicators modified indicator, but these are our pure indicators that we like to look at as well. Clearly the MACD went crazy. Here we can see that we had these trouble spots, what we call the 4-level negatives, way too many times. So there were at least 2, 3, 4 times when all the indicators dropped below the equator here, and that's usually not very good. We'd love to actually see them to stay above that, just kind of give us that steady growth area. But again, it's hard to complain about the year, and maybe that points out something. The more volatile something is, the more opportunities to lose money, but also to make money as well. Our oscillation versus correction, you can see obviously there was a major correction here. Indicators clearly pointed that out. We did trick a little below the line here, kind of more in that September time frame. So a little nervous because obviously could have kept going, but it didn't. It corrected itself. But we did have a pretty good number of times staying in the over positive. So, normal traction, and if you look at some of the other annual reviews, you'll see we kind of hang out between the two lines majority of the time. So here to see so many opportunities above the green line is really, really good. So again, that probably goes along with having deep lines here below the red line, excuse me. Market volatility, of course, was a struggle. Huge volatility when we get up into, it's just pure danger zone when you get up into these levels. So it wasn't as non-volatile of an environment. We didn't have a lot of times that we were actually below the stability line here. So that created a very volatile environment, which we didn't lose money. Overall, it was a fabulous year. You know, if you look at our worst year of 22%, our best year being 134, we really got pretty close to that. S&P did really well as well, 28.71. So we love to see that. But boy, oh boy, love to see that number. All right, so that's kind of our quick review of 2020. As always with this stuff, there are huge risks in using leverage, huge risk in using algorithms. If you're not that kind of a very risk-averse person, if you are, then of course, just invest in mutual funds over the long term. That kind of is where we are. And so use this information. Use it to help you build your own. There's no reason. I'm not asking you to follow it. Not telling you to follow it. There's no advice here. It's just kind of giving you a basic idea of where we're going. All right. Good year. Talk to you later.